Today is Sunday, December 20th, and this is a post-market review for the stock market activities on Friday and an outlook for the week to come. It is starting to look like Christmas, and we have breaking news. It appears that the stimulus has passed as of the time of the recording of this video. And here it is from Senator Chucky Schumer. After weeks of intense negotiation, we have reached an agreement on an emergency #COVID relief package. It will deliver emergency relief to a nation in the throes of genuine emergency. We must make law as soon as possible. Maybe he needs somebody to do a check on his tweets, one of the interns, because this doesn't sound structurally right. Anyways. And then we need to do even more under President Biden. There you go. More cocaine. He understands that the market probably not gonna like how light this package is, but he wants to keep the door open for more cocaine. We will discuss this issue more during the conclusion of this video, because it depends on another outcome, shall we say. But for now, for this video, I got a lot of subjects to cover for you. Number one, we will cover what happened with quad witching on Friday and trade for Tesla, the explosion in volume, and what happens next to the stock. Furthermore, we have very important decisions and developments through the weekend. The COVID-19 restrictions in the UK, and I also have data on consumer spending for the holiday season, in addition, of course, to the very important decision from the Fed to allow banks to resume share buybacks once again. We will talk about that in specific. JPMorgan and Wall Street's sweetheart Jamie Dimon. I will expose this piece of shit for you like you have never seen before. And of course, per usual, I have some corporate specific news for you that will impact certain stocks movements in the weeks to come. We got charts for you, the usual. Plus, I have two charts that are starting to look very bullish. I bought some call options on those two charts. We'll talk about them in the charts analysis. I also got two charts that are starting to look very bearish. And I bought put options on both, so we will discuss them also in the charts analysis. And of course, in the conclusion, we will look for the outlook for this upcoming week, what to expect after the developments over the weekend regarding the stimulus, the lockdowns in Europe, and of course, the seasonality of trading during this period. With that being said, we got a market to cover here. And here we go. The Dow Industrial Average closing in the red, 124.32 points, or a decline of 0.41%. The Nasdaq declining by 9.11 points, or a decline of 0.07%. S&P 500 slightly in the red, minus 13.07 points, or a decline of 0.35%. And here are the sector's performances for Friday. Number one, real estate, capturing the gold, silver, and bronze, because the rest of the performances were pathetic. The losers of the day, led by energy, utilities, and financials. But here's the contrasts, the weekly performance for the sector. Number one, technology, capturing the gold medal. Number two, consumer cyclicals for the silver. Number three, real estate for the bronze. And the only lagging sector for the week is energy. The winner the last few weeks, perhaps it is time to take a break for energy stocks. Moving on to the futures market performance on Friday, and here it is. Crude oil climbing higher, even though energy stocks are down. So perhaps the stocks are leading the way, and we will see crude oil futures pulling back starting next week. What do we see here in softs? We see cocoa softening here, along with sugar and coffee just slightly. The winners are OJ closing almost 2% for this session, and Lumbar closing at 850. Moving on to metals, what do we see here? Good day for copper and palladium. However, platinum, silver, and gold closing in the red. Muted action for meats. However, we see grains, soybean meal, soybeans, corn, and canola leading the gains for the day. Meanwhile, we see muted action here for oats, rough rice, wheat, and soybean oil. And by the way, the Federal Reserve keeps talking about inflation, but the only inflation they're worried about is wages. They're worried that your wages are going to go up. But take a look at, and do the homework please, take a look at canola futures and check out how high canola prices are. And if you go to the grocery store, notice how expensive cooking oil has gotten. But hey, that is the kind of inflation that the Fed is not worried about. Give me a break. Moving on to the big casino, the options market, let's see what happened on Friday. Right away, you see massive volume for both Apple and Tesla. Why is that? Money had to come from somewhere for money managers to buy Tesla shares. And the biggest cash cow available is Apple stock. You saw a surge in Apple's volume. They're dumping Apple shares to raise some cash to buy Tesla shares instead. And here it is, Apple at number one. With almost 2 million contracts traded for the day, about 68% of those were calls. Tesla at number 2 with 1.9 million contracts. About 61.5% of those were calls. NIO coming up at number 3 with about 800,000 contracts. About 70% of those were calls. And let's move on to cover some unusual trades that happened on Friday. And right away you see this put spread for Snapchat. They've been trying the same thing over and over again. The trick with this kind of trade is to lower your entry price as much as possible, and any sudden slide in Snapchat stock and you could double, triple, even quadruple your money pretty quick. They tried to do this last week. It did not work. Now they're giving it another shot. Here it is. They're buying the 50 puts, expiration date New Year's Eve, and they're paying about 80 cents for this trade. In addition to selling the 48 puts, expiration date also New Year's Eve, and they are collecting about 40 cents for this trade. All in all, the entry price is reduced to about 40 cents, and now all you need is just a little slide in the stock, 3-4%, and you could double your money easily. But again, this is a wild shot trade from a trader who has a lot of money, but it does not hold any value for us because it is not an insider trade or a notable trade one way or the other. So we'll move on. And here is an interesting trade for the XLI, the Industrials ETF, one of the best performing sectors since post-elections. But this time around, they're buying puts, specifically the 84 puts, expiration date New Year's Eve, with expectation that industrials will decline by about over 5.5% by then. And moving lower in the table, we see a very interesting trade for Roku, and they're buying the 360 calls, expiration date Christmas Eve, meaning this upcoming week. Remember, it is a shorter week anyways. We have a half a day of trading during Christmas Eve, and Christmas Day we're off. So this is a very high risk trade considering how expensive it is, because they're paying over $3.40 a piece for this trade, which brings the total premium traded for this trade over $2 million. So over $2 million on the line here for about 3 days and a half worth of trading. Very, very high risk. And of course, there is another side of the trade. There's somebody who's trying to raise cash by selling upside calls. And probably this is the strategy that I'm going to conduct this upcoming week. It is a shorter week and you need to use it to raise cash. So that is the goal, and we will discuss more during the conclusion of this video. But for now, moving along, we see another interesting trade for Plug Power, the ticker PLUG. This is one of the Robinhoodiots' favorite names, and this time around they're betting on more upside, buying the 36 calls, expiration date January 15th, with expectation that the name will climb over 14% by then. They are paying almost $1 million for this trade alone. What about Peloton, the ticker PTON? It's been one of the hottest stocks this week. However, somebody's betting on a retreat and a reversal here, buying the 130 puts. Expiration date also Christmas Eve, meaning this upcoming week, and they are paying over $500,000 for this trade alone. And here is the last interesting trade of the day for Hack, the ETF for cybersecurity, and they are buying the 60 calls, expiration date January 15th, with expectation that the name will climb over 5.5% by then, and they are paying about $500,000 for this trade alone. We heard about all the hacking scandal that took place, and now traders are making a bet that the cybersecurity ETF will rise much higher from this point on. Moving on to the headlines that shaped the day. We talked about stimulus, so we're not going to talk about it right now, but we will revisit the subject during the conclusion of this video. However, over the weekend we heard news from overseas in Britain. Here it is. Britain tightens lockdowns as new coronavirus mutation shows significantly faster rate of transmission. So there goes your vaccine optimism. But hey, to the Robinhoodiots, more coronavirus variants means more vaccines, means more vaccine optimism. Split vaccine optimism. It works just like the stock splits in Tesla and Apple. It produces value somehow. But all jokes aside, here it is. The lockdowns, restrictions in Britain. I guess the Christmas holidays were canceled over there. But rest assured, you're not alone because we have the same thing pretty much here in California. We've been under lockdown for a while now. But perhaps the most interesting news from Friday came from Tesla stock. Everybody was expecting a large, massive move in the name due to the inclusion in the S&P 500. What happened is initially we saw a pop in the morning, but remember it is quad witching Friday, so they have to play a trick here. Everybody went into Friday locked and loaded buying calls to extremes. We're talking about way out of the money calls for Tesla, expecting the name to jump 10, even 20, 30% on Friday alone. So they bought them on Thursday with expiration the very next day. And we're talking about billions of dollars were committed for Tesla calls expiring on Friday alone. So what did the big guys do? They actually started selling Tesla at the beginning of the day, keeping the name flattish pretty much throughout the day. That means that the majority of these options, the call options, specifically the ones out of the money, started losing value very, very fast, meaning shaking out the weak hands. And by the last hour of the day, what happened? All of these call option holders started to give up and they started to dump Tesla shares, knowing that there isn't going to be a massive pop. As soon as they started selling off, the big boys hopped in and they bought Tesla stock with both hands, pushing the name all the way to close up above 5% for the session. And the bulk of the buying happened during the last 15 minutes of the day. You think that was done intentionally? No. They did it because they wanted to shake out the majority of the weak hands and the gamblers who made bets via call options. And here is the result. You see the explosion of volume. Absolutely unprecedented volume here. We're talking about almost $150 billion traded in Tesla stock alone on Friday. You compare that with the total dollar amount of the entire volume traded for the SPY, the S&P 500, that was at around $50 billion. Meaning that Tesla traded at 3 times the entire index they're about to be included in. Absolutely stunning and historic day. And by the way, what are the implications of including Tesla in the S&P 500? Here it is. Remember, we've been complaining about the PE ratios being very elevated. But wait for it, because Tesla is about to explode the PE ratio for the S&P 500 by about 2 points from 29 to 31. So Tesla alone, single-handed, added 2 points to the PE ratio of the S&P 500. That tells you and illustrates for you how overvalued and insane Tesla stock is right now in terms of valuations. But with all this money that's been trading in Tesla stock and Elon Musk adding $9 billion to his net worth on Friday alone, somehow Reverend Elon, as cheap as he is, missed $100 million deposit for the Gigafactory in Berlin. So he was forced to stop the construction of the factory. Remember that he forgot to pay the water bill in the Texas factory and they shut down the water. Somehow, the second richest man on the planet, either too cheap or he's handling his bills as a college boy. But speaking of EVs, Toyota CEO came out with a very controversial statement saying that the more EVs we build, the worse carbon dioxide gets. He also added that he feared government regulations regarding EVs will make cars, quote-unquote, flower on a high summit, out of reach for the average person. And I posted some articles on my Twitter page showing you that EVs are pretty much worse for the planet than combustion engine cars because they're chopping down the forest to dig for mines. They're using child slavery labor in the Congo to mine for cobalt. And all the nickel that they're using, the waste gets dumped back in the ocean. They're dumping an insane amount of toxic waste back in the ocean, endangering marine life. And it is so happened to be that the resources needed to build the batteries for EVs are concentrated in very critical areas on this planet in terms of ecological and biodiversity, meaning that the more EVs we build, the more forests we have to chop, the more oceans we have to pollute, and the more wildlife we have to threaten. But keep telling me that EVs and Reverend Elon somehow are going to save this planet. Let's move on to cover some data about consumer spending during this holiday season. Remember that Saks CEO predicted that the consumer is flush with cash and they cannot wait to splurge this holiday season and buy luxury goods. Furthermore, you heard from that asshole on CNBC who said that the consumer is going to have plenty of spare cash to spend this holiday season because they don't need to spend on bottles of champagne and hire caterers this holiday season because they're not going to be doing parties anymore. So that cash will go on to be spent on sweaters and other useless shit. But here it is, the real data. Christmas shopping season has been one big bust. Data from these 30 million people show. And who predicted this, by the way? This channel ahead of time told you that the consumer is very weak. Forget about the splurging and all the pornographic fantasies from Wall Street CEOs. Santa's sleigh looks like he will be coming down on rooftops this Christmas Eve, much lighter than most on Wall Street expected. Surprise, surprise. At least that is the hot read from some less than cheery new data out of JPMorgan. Total spending on 30 million Chase credit and debit cards dropped 5.4% year over year from 4 weeks before Black Friday through December 14th. What JPMorgan calls card present spending has crashed 18% from a year ago for the holiday season to date. And here is the chart illustrating to you how big of a drop in consumer spending we are experiencing this holidays season. So always listen to these geniuses on Wall Street and the business news media because they obviously know everything. And here is more disturbing news since we're talking about the stimulus and the next round of PPP loans. We have some data for you about the last round of PPP loans and all the scams and the theft that took place last time around. Here it is. As Congress struggles to approve the $900 billion in stimulus funding, this is of course old news. They've already passed the stimulus, but here it is continuing. A new report shows management of last loan program was so bad an audit cannot be done on where $670 billion in taxpayer money went, meaning that over $670 billion poof, disappeared with no trace, no track whatsoever. $670 billion from taxpayers' money that was intended to go to the PPP loans program to help small businesses. Instead, it took the way of crony capitalism and somehow found its way in the pockets of country club owners and golf courses, billionaires and millionaires connected to the administration. $670 billion of your taxpayer money is missing. Are you going to do anything about it? No, you're not, because the majority of our population have their heads stuck deep in their asses where the sun don't shine. And here is to illustrate for you the chart right here. Most PPP money went to a fraction of the recipients. The top 1% of loans account for more than a quarter of all loan value. Meanwhile, the top 5% of loans account for more than half of all loan value, meaning that a lot of small businesses in this country did not even see the first round of PPP loans, and they were forced to shut down their operations permanently. Moving on to the Federal Reserve, and we heard from Vice Chairman Clarida, who said that the U.S. will likely avoid slipping back into recession as growth rebounds next year. So, Mr. Clarida, are you going to cancel the cocaine operation right now with the lending facilities since we are likely to avoid slipping back into recession? Are you going to stop buying Apple bonds? No, you're not. Because it's not about that. It was never about saving the economy. It was about saving and propping up the assets of the rich. And then we heard from Kaplan. Remember Dallas Fed President Kaplan with his $10,000 sofa? And there are rumors that say that this sofa is actually worth over $50,000. But here he is. Kaplan says, I worry that bond buying has some distorting impact on price discovery. No shit. Here it is. That they encourage excessive risk-taking, and excessive risk-taking can create excesses and imbalances that can be difficult to deal with in the future. Oh, now you're realizing what's going on here. But I don't understand, Mr. Kaplan, why are you being an alarmist right now? Because your boss, Federal Reserve Chairman Jerome Powell, says don't worry about PE ratios or anything like that. Don't worry about valuations, any excessiveness in the market. That is okay because we're going to continue to keep the 10 years yield as low as possible, as if he has full control over the 10 years yield. Continuing with the Federal Reserve and perhaps the most disturbing news on Friday. Here it is. The Federal Reserve gave Wall Street banks the green light to resume billions of dollars worth of stock buybacks. Wait a minute here. If the Federal Reserve is insisting in continuing and perhaps expanding the cocaine operation because the economy is not out of the woods yet, then you would think the banks should be on restrictions and on hold for a longer time period, because we don't know the magnitude of the scarring in the economy, how many businesses will default, how many loans will be default, meaning the banks should hold on share buybacks and put some money in their reserves for a lot longer until we are completely out of the woods. But the Federal Reserve is saying now, no, it's okay, we're out of the woods already, and banks can resume share buybacks. But you're also saying that we should continue our assets purchasing program because the economy is not out of the woods yet. Which one is it, Jerome? Which one is it? Again, the Fed is a very confused organization. They're playing multiple sides at the same time. They want their cake. They want to eat it too. But most importantly, they want to give a gift of goodies to Wall Street. And the reason is they're not worried about loan defaults for banks is the fact that the stimulus is going to pass. And that was, by the way, your leading indicator that the stimulus will pass on the weekend. And once the stimulus is passed, those PPP loans will pretty much compensate for any defaulting loans, meaning that small business owners and some not small business owners will get another round of PPP loans. The banks will process these loans, collect processing fees to do that, hand it to small business owners who are going to use the money to pay back the bank for outstanding loans and rent, etc. Meaning that the banks are about to launch another round of money laundering operation, and they get paid in the way in and the way out. They get paid to process the loan, and then they get paid to recoup the loan altogether again. Criminal organizations. And they're about to make a lot of money. Are any of your beloved politicians are even aware of what's going on here or protesting the crimes of Wall Street? No, they're not. They're complicit in it. And here it is. The Fed will once again allow Wall Street banks to resume stock buybacks. JPMorgan immediately announces 30 billion of shares repurchases. Its shares pop in after market trading. No shit. You saw JPMorgan jumping almost 5% after hours because they're about to pump 30 billion bucks buying back their stock. It is no brainer here. The JPMorgan will outperform in the stock market after allowing shares repurchases. And perhaps this is a good stop to talk about JPMorgan and remind the viewers that JPMorgan is one of the top criminal organizations in this country. And we called in this show the Landromat. Why do we call it that? Because it got caught washing billions of dollars for criminal organizations, drug cartels, but mostly mobsters. And let's talk about Wall Street's sweetheart, JPMorgan CEO, Jamie Dimon. You know, the business news media, they love this guy. They worship him like an idol. When he speaks, they break their programming and they go into breaking news. Jamie Dimon said something, and when they interview him, they play the interview all day long. They talk about him. They gloat about his hair, his tan. Oh my God, his tan. Have you seen Jamie Dimon's tan? His suit, his smile, oh my God, his stature, right? But the truth is that Jamie Dimon is a gangster. He's a piece of shit criminal at the end of the day because he goes around and he pretends to be some people's champion, and he goes around and reminds you that he might be a banker in a Wall Street elite. However, he's just a tough guy from Queens. He always reminds you how tough he is, how poor he was. He just grew up in Queens. and magically he became the billionaire CEO of JPMorgan. And remember that tough guy, Jamie Dimon, of course, he learned how to talk tough from hanging out with mobsters while he washes their money. And he went live on air and he said that he can beat Trump, that he's smarter than Trump, and he earned his money, and it wasn't just a gift from daddy.
I said this before Trump was elected. You're not going to get a wealthy New Yorker elected president. Boy, I was dead wrong. And by the way, this wealthy New Yorker actually earned his money. It wasn't a gift from daddy. And I grew up in a poorer part of Queens than he did, but I am a banker. I am part of the elite. I don't think the American public looks at Trump as part of the elite. They look at him as the upstart who punched the elites in the nose every day. Because I'm as tough as he is, I'm smarter than he is, I would be fine. He can punch me all he wants and it wouldn't work with me. I'd fight right back.
And all it took, of course, is Trump making one tweet, just one tweet, attacking Jamie Dimon, and immediately Jamie went back in his hole and he said, forget it. I'm not thinking about running for president. Matter of fact, he said, I'm a patriot, so I will help Trump. And he went on television and said this.
I shouldn't have said it. And I more out of frustration and a little my own machismo, but I shouldn't have said it. And and also proves I wouldn't be a good politician.
So Jamie immediately folded like a chicken. What happened to the tough guy from Queens? But here he is, pretending to be a people's champion, taking a knee, pretending that he cares about Black Lives Matter. But the truth is that Jamie Dimon is the last remaining bankster from the 2009 submortgages crisis. And back then, his bank and Wells Fargo, among others, they actually intentionally targeted black folks, specifically poorer blacks, because they thought that it is easier to scam black people by offering them the dream house for very low down payment or mortgage payment. What do you know? They foreclosed the homes on these folks. They took the homes back, and we, the taxpayers, had to bail Jamie Dimon's ass back. And here it is from the New York Times. Bank accused of pushing mortgage deals on blacks. Furthermore, and this is from the National Magazine, special investigation, how America's biggest bank paid its fine for the 2008 mortgage crisis with phony mortgages. This was 100% a criminal scheme in which Jamie Dimon was involved. However, he got away with just a slap on the wrist. Continuing, you know the old joke. How do you make a killing on Wall Street and never risk a loss? Easy. Use other people's money. Jamie Dimon and his underlinings at JPMorgan Chase have perfected this dark art at America's largest bank, which boasts a balance sheet 1/8 the size of the entire U.S. economy. But somehow they need to scam the people. Continuing. After JPMorgan's deceitful activities in the housing market helped trigger the 2008 financial crash that cost millions of Americans their jobs, homes, and life savings, punishment was in order. Among a vast array of misconduct, JPMorgan engaged in the routine use of quote-unquote robo-signing, which allowed bank employees to automatically sign hundreds, even thousands of foreclosure documents per day without verifying their contents. But in the United States, white-collar criminals rarely go to prison. Instead, they negotiate settlements. Indeed, they do. Continuing from the same piece, here is how the alleged scam worked. JPMorgan moved to forgive the mortgages of tens of thousands of homeowners. The feds, in turn, credited these canceled loans against the penalties due under the 2012 and 2013 settlements. But here is the rub. In many instances, JPMorgan was forgiving loans it no longer owned. Wow. The alleged fraud described in internal JPMorgan documents, public records, testimony from homeowners and investors burned in the scam, and other evidence presented in a blockbuster lawsuit against JPMorgan. And you might say, oh, that is the past. JPMorgan might have been reformed by now. Jamie Dimon learned his lessons. No. Here it is. In 2020, September, 28th. The article from Bloomberg. Inside the JPMorgan trading desk, the U.S. called a crime ring. The U.S. government called JPMorgan a crime ring. The U.S. says that precious metals desk at JPMorgan was a racketeering operation. Now the bank is poised to pay a record penalty for spoofing. Here is a look behind 8 years of the alleged conspiracy. They've been running this scam, manipulating the prices of metals every single day. The government called it racketeering. You know what that means? This is like Al Capone and the mafia. But somehow these white-collar criminals get away with the crime every single time. There's just a price to pay, they pay the penalty, and they go at it again. Furthermore, here's from Reuters. JPMorgan probing alleged misuse of PPP funds by employees. Memo shows. Is this a bank or is this the biggest criminal organization in the world? And here it is from Forbes magazine. Is JPMorgan Chase America's most corrupt bank? Furthermore, from Medium magazine, how is a corrupt criminal like Jamie Dimon not in prison for fraud? Indeed, how the hell is Jamie Dimon is not in handcuffs or orange suit right now? In addition, here is from Vanity Fair. Jamie Dimon's $13 billion secret revealed. This is how he scammed homeowners and he got to be compensated by the taxpayer and the Fed. And he became richer than before. His bank got to make all of their losses from the mortgage scam of 2008 and then some. And perhaps let's finish with this so you can know how big of a piece of shit Jamie Dimon is. Here he is. Jamie Dimon defends capitalism in annual letter. Quote unquote, socialism inevitably produces stagnation, corruption, and even worse. How dare you, Jamie Dimon? How dare you talk about corruption, you malignant piece of shit, corrupt asshole. You should be in jail, not leading America's largest bank. But again, it is America's largest criminal organization, so who is a better fit to lead this criminal organization than Jamie Dimon himself? So next time the media tout Jamie Dimon as some working class hero and an honest guy in Wall Street, remember that he is a gangster at the end of the day. And speaking of corruption, and I apologize in advance for upsetting you a little more than usual tonight, but here it is. Virgin Galactic Holdings shares down 5.9% pre-market after call files for secondary stock offerings, meaning that they're diluting the shares. And of course, the Robinhood has been buying this stock, which has no revenue to begin with, but it is the future, bro. So why am I upset about this news? Here it is. Remember Chamath Palihapitiya, who also pretends to be a Main Street hero, and he went on CNBC saying that let Wall Street go bankrupt?
Are you arguing to let airlines, for example, fail?
Yes.
Why? I mean, how does that make sense in the broader scheme of the economy?
Because it's not, because when you look at what it means, this is why I'm saying, like, this is a lie that's been purported by Wall Street. When a company fails, it does not fire their employees. It goes through a packaged bankruptcy, right? If anything, what happens is the people who have the pensions inside those companies, the employees of these companies, end up owning more of the company. The people that get wiped out are the speculators that own the unsecured tranches of debt or the folks that own the equity. And by the way, those are the rules of the game. That's right, because these are the people that purport to be the most sophisticated investors in the world. They deserve to get wiped out.
Well, if you thought that Chamath Palihapitiya is the good guy, you need to rethink again. Because Chamath, earlier in the week, dumped a massive amount of his Virgin Galactic shares ahead of the announcement of the dilution of the shares. Matter of fact, to the tune of about $100 million. And somehow we should believe that this is just a coincidence and Chamath did not know about the secondary offering. Bullshit. He did know indeed, and he did dump about $100 million worth of Virgin Galactic shares. And of course, Chamath was called out on Twitter and he issued this tweet to defend himself. Please note that I filed a Form 4 for the sale of 3.8 million shares of Space. I sold these shares to help manage my liquidity as I fund several new projects starting in 2021. I remain committed and excited for the future of Space. Just wanted to be transparent. No, you did not. You're a crooked Wall Street, Silicon Valley billionaire, just like the rest of them, Chamath. And unfortunately, you will get away with it because the SEC is a dormant, sleeping organization. And this bad behavior from Wall Street that you called out and you said let them go bankrupt continues to go day after day with no punishment whatsoever. And then you wonder why people are starting to resent billionaires, resent Wall Street, resent Silicon Valley, a matter of fact, resent the whole economic system of America. Capitalism, because it is not working for them. And the take here for the Robin Hoodies and the dummy retail traders. You think these guys have your interest in mind? No, they're not. They're only consumed by their own self-interest. And what you do with your dumb money when you buy a company that is valued over $2 billion with no revenue, the company doesn't even operate yet, but you continue to buy it because it's quote unquote the future, bro. All what you're doing is push the stock valuations higher and higher. And then here comes the billionaire, takes a dump on your head, crashes the shares, and say, oh, I needed some liquidity for my new projects. I still believe in the stock. So keep doing what you're doing with your dumb retail money. All what you have accomplished is making these rich criminals even richer. And you don't get to keep your gains either. Again, Chamath Palihapitiya, I thought you were the good guy, but you disappoint me again. And lastly, let's move on to cover some corporate specific news, starting with Zoom. And here it is. Zoom says it's being investigated by the SEC and 2 U.S. attorney offices. All of a sudden, the SEC is waking up from about 10 years coma. They're issuing lawsuits against Robinhood and now Zoom. But again, don't expect them to come after Jamie Dimon or Chamath Palihapitiya. Those people are at a limit for the SEC. Moving on to United Airlines. What do we have here? United Airlines in talks with the CDC after passenger death possibly due to COVID. Remember when the Harvard study came out and said that flying couldn't be safer? It's almost impossible for you to catch COVID on a plane. And again, I'm not very sure that it was from Harvard, but it was scientists and professionals issuing this declaration. And now we know that they were probably paid by the airlines lobby because here is a passenger catching COVID on a plane and possibly many more. And the last bit of news I have for you is for Intel. Remember that Apple is dumping Intel and producing their own chips. And now Intel is catching a double whammy because Microsoft is working on in-house designs for chips to run its cloud servers and Surface PCs, the latest tech giant to reduce the reliance on Intel's technology. So Intel lost its 2 biggest clients, Apple and Microsoft. What are they going to do now? Do they even have a business left at Intel, or should they start selling hot dogs instead? Moving on to the heat map analysis, and we're going to go a little quicker here because we're running out of time. And I have a lot to discuss during the charts analysis, so here we go. Starting with the heat map on Friday, what do we see here? All in all, it was a mixed picture, very muted. You see Intel getting hammered right away, flashing bright red, down over 6%, but you saw the big boxes of technology not doing much, being sold off because the cash has to come from somewhere to prop up Tesla stock and buy shares. And you see Tesla stock closing about 6% for the day. We also saw that some of the hottest trades for the last few weeks, such as materials, energy, industrials, all muted for the session. The biggest loser, of course, is real estate. I showed you some unusual activities of traders buying put options against the real estate ETF. And on Friday, you saw real estate names getting hammered significantly. We also saw action in video game names such as Activision, Blizzard, Electronic Arts, and Take-Two, closing in the green because the failure and the flop of Cyberpunk 2077. They're issuing refunds all over the place. The game was the biggest bomb in video games history. And now you see that the shares of alternative video game makers, Activision Blizzard's, Electronic Arts, shining green. We have notable losses here in the consumer defensive sector, specifically for Cisco. We saw losses for utilities. We saw losses for healthcare, specifically health insurance. Cigna was down almost 3%. Moderna was down. It was a muted action all in all in the healthcare sector, with exception of Novo Nordisk, another day of gains, almost 3%. We saw red activities for the financial sector here. Banks down, regional down, Goldman Sachs, Morgan Stanley down, credit services muted, with exception to MasterCard, closing about 1% for the session. Let's move on to the weekly picture of the heat map, and it is different. Right away, you see that with exception to Intel, the technology sector was the biggest winner by far. And when we move to communication services, we see that AT&T is taking a break, and perhaps this is a buying opportunity for the name. But we see massive gains for Netflix and video games names. What about consumer cyclicals? We saw massive gains here for Tesla, for residentials, due to the earnings of Lennar. We saw good earnings here for the name. Unlike Toll Brothers, by the way, a few weeks ago, we saw gains for apparel retail, restaurants, casinos, some of the cruises. But the biggest winners here, aside from Tesla, is Wayfair, closing up over 13% for the week, and eBay over 8% this week alone. When we move on to consumer defensives, the biggest winner is Estée Lauder, closing over 6% for the week. The biggest losers are Tyson, over 6% to the downside, and Cisco, almost 5% to the downside this week alone. What about REITs? REITs got hammered on Friday, and that ate some of the gains for the week, because all in all, the week was not bad for REITs, but Friday in particular was bad. The biggest winner in the session here, the week, is CoStar Group, the ticker CSGP, closing over 6.5% for the week. What about utilities? Mixed picture here, but the biggest winner is Exelon Corporation, the ticker EXC, closing over 3% for the week. Another good week for basic materials, led by copper, the gold miners, but the name Valley remains one of the biggest winners, scoring another 3% this week alone. Now, the biggest loser for the week is the energy sector, and we see right away that Chevron remains the weakest name. It is not performing very good, down over 5.5% for the week. And it is very notable that Chevron has been underperforming Exxon for weeks now, and you see that this week is no different. Exxon only down about 2.5%, Chevron down over 5.5%. What do we see here in industrials for the week? Right away, it was a big week for UPS, over 4%. However, not a good week for FedEx. The opposite picture, down over 4% after reporting their earnings. The winners for the week, ADP closing over 3%, Paychex over 5.5%, Deere almost 6% for the week. We see M also closing over 1% for the week. The notable losers here, beside FedEx, we have Boeing down over 4%, Honeywell down over 2%. Moving on to healthcare, what do we see here? A contrasting picture between Eli Lilly, the biggest winner of the week, over 7%, along with Bristol Myers, about 4% gains for the week, versus Pfizer down over 8%, Merck down over 4%, AstraZeneca down over 7%. Remember, the Pfizer, Merck, AstraZeneca been outperforming for a while. Perhaps the money's coming out of these names now that the vaccine is out, and it's coming back to Eli Lilly, Bristol Myers, and Johnson & Johnson. What about biotech? What do we see here? Moderna is the biggest loser by far, down over 10% for the week, but we see massive gains for Novo Nordisk, Vertex, and Regeneron. Diagnostics did pretty well, specifically Illumina over 7%, outperforming Thermo Fisher. But I remain consistent that Thermo Fisher will outperform Illumina in the long run. Illumina got hammered hard the last few weeks, last few months, matter of fact, and it will bounce higher because it is a high beta name. But Thermo Fisher remains the gold standard when it comes to diagnostics. Moving on to financials, what do we see here? Muted picture across the board, with exception to credit services. PayPal, which should be in technology, not credit services, up over 10%. MasterCard almost 4%. Visa over 2%. However, Amex, AXP underperforming, down over 2% for the week. When it comes to Goldman Sachs, Morgan Stanley, muted for the week, but we see a notable outperformer here in Charles Schwab, closing the week over 5% in the green. And let's take a look at the picture for the weekly heat map for ETFs. Right away, we see any inverse ETF got smacked really hard. whether it's inverse ETFs for the Dow, for the Qs, for the SPY, IWM, it didn't matter. We saw also declines in VIX proxies and notable declines in the energy sector, but we saw a rebound here and gains specifically for semiconductor names and a continuation of the gains for the healthcare sector, specifically biotech. When it comes to international ETFs, the outperformance from the Brazilian ETF EWZ remains notable. However, it is subsiding just a little bit. It is not outperforming the rest of international ETFs by much as it did in the last few weeks. Moving on to the rotation trade, what do we see here? It is notable that it is a mixed picture. However, we see that the momentum names outperformed significantly here when you look at double-digit gains for Peloton, PayPal, Shopify, Tesla. Meanwhile, we saw some notable gains here in the comeback stocks, the reopening stocks in Live Nation, Ulta Beauty, TJ Maxx, but they pale in comparison when you look at names like DocuSign or Peloton or even Zillow in the momentum names. The notable loser here in the reopening names is Chevron, down 5.69% for the week. And the notable loser for the momentum names, aka the stay-at-home stocks, is FedEx, down over 4.8%. Let's move on to the charts analysis, and right away starting with the SPY. 15 minutes. What happened here? We gap lower. We continue to slide lower and lower and lower. The purpose here in quad witching is to kill call options buyers first, and then by the end of the day, kill put option holders right away. It is the same playbook we saw back in September. And here it is. You see the SPY sliding, then rebounding, touching what level? 369.60, finding it as resistance, and then reversing back again all the way to the lows of the session. You think these numbers are picked randomly? No, they're not. 369.60 to the penny. But what happened at the end of the day? They want to kill put options holders, so they pumped the market. They bought Tesla, of course, and you see the SPY surging higher, but yet closing under 369.60. And that is an important take. Let's switch to a daily chart and see what's going on in the SPY. It is a bit of a mess here with all the lines, but there is a point to illustrate for you. Take a look at the MAC. Don't lick the screen, please. Take a look at the MACD indicator for the SPY. Now understand that the MACD indicator is a lagging indicator, meaning that it is showing you moments when the chart start to accelerate or deaccelerate in momentum. Now there are off-label uses for the MACD, and I do that a lot, but I'm not going to showing you here because it is controversial and I want to stick to the traditional rules. But every time, let's go back to September 3rd when you saw the crossing in the MACD, and this is a significant crossing, not a fake one, not just a tiny one. This was a big crossing, and right away that was your signal that the SPY is losing momentum in the upside and the momentum is starting to accelerate to the downside. When you switch to September 30th, you see the opposite, the MACD climbing higher, crossing to the green side, making green impressions in the histogram. That was your moment that we are accelerating to the upside, and that was your buy signal. And again, 23rd of October, you saw a crossing to the downside. You're starting to get the theme. The 5th of November, a crossing to the upside, and you know what happened. The SPY been grinding and grinding and grinding higher all the way until December 9th. We saw a crossing to the downside. It is not definitive yet, but it's starting to look like one. And if history is about to repeat itself, this means that we will accelerate the momentum to the downside in the weeks to come. And you also see the RSI indicator curling downward. Now, let's move on to the SPY futures, the continuous contract. And we are in a pivotal point right now. We've been battling in range. We have an upper limit and we have a lower limit. We have revisited the upper limit about 4 times and we got rejected from it. We have visited the lower limit of the range and we caught support twice from that level. What does that mean? It means that we are still in a range, but we are hanging at the upper end of the range. That in itself is bullish. However, you need to break above that level as soon as possible to create momentum, to say goodbye to this range, and hello, another leg for the rally in the SPY. Otherwise, if we're going to face another rejection and a sell-off, then eventually we will go back to the lower limit, and that would be about 10% correction in the SPY, and then take it from there. So that is the outlook from now. You got to break above the upper limit very soon to create another leg in the rally. Or otherwise, if we get rejected once again, the next destination will be 10% to the downside. Moving on to the Qs, and a different picture here. Remember, we've been talking about an upcoming rotation of the rotation from the IWM back to the Qs. You see that the Qs did a lot better than the SPY, gapping higher, being sold off all the way to the end of the day, but catching support from the level of 308.50 and blasting higher by the end of the day. That is, of course, due to the stampede to buy Tesla shares during the last 15 minutes of the day. But all in all, better closing here for the Qs when you look at the SPY and the IWM, which we will look at in a second. But first, let's take a look at the daily chart for the Qs. Again, looking much better than the SPY. However, it looks that the rally is getting extended, and we are seeing a lower divergence here in the RSI indicator. It's too early to make conclusions, but it is noticeable here that we are witnessing weakening in the momentum. And here it is, the IWM, 15 minutes. Right away, you see we gapped higher. We started trading higher all the way till the end of the day, and then during the last 2 hours, we started seeing a sell-off in the Russell, and the sell-off intensified by the closing bell. All in all, we're still very close to all-time highs. We're closing above all of the support levels. So in the grand scheme of picture, the Russell is still bullish, but it is notable that we are seeing weakening here when you compare it to the Qs. Moving on to the daily chart, what do we see here? A very extended chart. It is starting to look very ridiculous right now, and the higher we go, the more violent the correction in the IWM is going to be. However, you could play the game of trying to capture the move before it happened, meaning bear FOMO. Guess what? I have some of that too. And about a week ago, I bought shares in the TZA, the inverse index of the IWM. I got my ass whooped right away, and my stop loss order got triggered. So here's how you do it. If you want to play the move ahead of time, because this is going to be a very violent correction, so you don't want to wait till the move happens. I mean, you should, but I know most of you, just looking at the psychology of traders, are trying to chase this move ahead of time. So if you're going to do it, make sure that you use stop loss orders. Otherwise, you could suffer if the IWM continues to grind higher and higher. And it could, but we're getting very extended here. The move always starts with institutionals, the early adapters. They buy the IWM after the elections due to the vaccine news and the rotation, and then retail piles in, adding to the momentum, and it becomes ridiculous. And guess who the last round of buyers are? Shorts covering for their losses, meaning that they try to call a top, they short the IWM, it doesn't go their way, so they have to cover their shorts and buy shares of the IWM, and when they do that, they accelerate the movement to the upside, and now they become complicit in the move. They like that the IWM is all of a sudden going higher and higher every day. However, at some point, we run out of buyers. And I like to hear the pulse from you guys on Twitter and otherwise saying, oh, I'm giving up. I keep shorting the IWM. It doesn't work. I'm just going to go long the IWM. When I start hearing this kind of narrative more and more, it is a signal that we are reaching a top in the IWM. But again, you'll never know when that top will be formed exactly. So if you're going to play the game of guessing and trying to catch the top, make sure that you use stop loss orders. Moving on to the VIX, what do we see here? The VIX is not looking good, and it is another point to the bulls who are betting on a Santa rally, because this is the second week where the VIX gets rejected from the very important level of 25. I will still give the VIX the benefit of the doubt. However, it needs to perform as soon as possible. What do we see when we move on to the put to calls ratio in equities? This is from a weekly perspective, and I am showing you that every time we dip to these levels, we had a correction, sometimes a crash. And you see that the put to call ratio is curling downward once again, meaning that market participants are very comfortable and very confident that we are going to have a Santa rally. Matter of fact, the rally will intensify in the upcoming year, so they don't need protection whatsoever. We will see if they're right or wrong, but history suggests that they are wrong and they will be caught with their pants down. Moving on to the Dixie. What do we see here? It was a bounce on Friday for the Dixie. However, it was a brutal week overall, but we are very oversold, and I'm highlighting the level of about 21.6 in the RSI, showing you that the US dollar is extremely oversold right now, so it is not out of the norm that we see a bounce next week, perhaps all the way to the end of the year. And when we zoom out in the dollar index, you see that every time we reach this particular level, we had a rebound in the dollar index. Again, if history is going to repeat itself, we have a rally, a bounce coming in the dollar index. What does that mean for gold? Gold is starting to look bullish here. However, if we see a rally in the US dollar, that could impact and hold the rally in gold. But gold is looking good. It broke and closed above 1870, the resistance level. And it is starting to look like a head and shoulder formation in reverse, meaning that there is more upside for gold. You see a successful crossing here in the MACD and the RSI climbing higher, suggesting momentum. So I remain bullish on gold. Moving on to the TNX 10 years yield. Jerome said that the 10 years yield will remain low forever, but the TNX is giving the mid finger to Jerome, and it is climbing higher and higher, and it is just a matter of time before we hit 1%. So again, I showed you the news about JPMorgan and Goldman Sachs. These are criminal organizations, and now they will be rewarded by higher yield, so perhaps it is a good opportunity to invest in some of these racketeering organizations. Moving on to Apple, what do we see here? A lot of you might read something about the closing on Friday. I will not. They had to sell some Apple shares to buy Tesla. That is it. Apple remains bullish. It remains on the trajectory to go all the way to challenge all-time highs. If it starts breaking 125 and then 120, then we will know that Apple got exhausted, and that's all there is for the bounce and the rally in Apple. Moving on to Tesla, what do we see here? We got a nice bump on Friday, a very significant one. Look at the surge in volume. It is absolutely unbelievable. And you see Tesla closing above the upper limit range, but here it is. There was significant uptick in volume, and all of what Tesla did is about 6% to the upside. That is it, meaning that don't be surprised that the break above this upper range limit is a fake out, and by next week, we will curl back and trade in range once again. Remember, I'm not shorting until Tesla hits the 84 level on the RSI. And here are two bullish charts that I would like to show you, and I bought call options in both on Friday's session. Number one, Wayfair. You see that Wayfair, one of the hottest runners since the March bottom. And I bought shares of Wayfair when it went down to 26 bucks. But the dummy I am, I sold them back in the summer. What do you know? The stock blasted all the way to over 300 bucks. Now, am I buying the stock again? No, I'm just buying calls, playing a trade, because this stock will get hit during a correction. It does not mean that it is a bad stock. It is heavily shorted, meaning that you're going to see more short covering rallies. Furthermore, it is not absurdly valued, contrary to many beliefs, meaning if you look at the price to sales ratio, it is actually a cheap stock. Furthermore, it is likely that the momentum they gained from the COVID-19 crisis and the stay-at-home, it is likely to stick, because once you adapted Wayfair as a platform to shop for furniture, you're not going to switch back and go to the store once we reopen the economy. You already found a more convenient way to shop for furniture. So I am bullish on Wayfair, and I see the stock breaking out above this consolidation range that you see on the chart. Here's another one for Goldman Sachs, and this is a weekly chart. And I did buy call options on Friday. I swear I did not know that the Fed will reinstate shares buybacks for banks after the session. Otherwise, I would have told you. But it is a cherry on top that Goldman Sachs popped higher after hours. And I see the stock beating the upper range of consolidation and making further gains. Now, I bought the January calls. And if we see Goldman Sachs blasting higher, I'm building 10, 20% gains all the way till January expiration. It is a long shot, but it is possible. I will convert and exercise my call options and I will own shares of Goldman Sachs. Now, here are two bearish charts starting with FedEx. And I bought put options on those on Friday. FedEx reported earnings. They were good earnings, but the stock is mispriced. It is way, way overvalued right now, and you see it getting punished on Friday's session. Furthermore, we have a successful crossing to the downside in the MACD and a downward divergence. Likewise, we have a downward divergence in the RSI, suggesting massive weakening in the momentum. Now, you saw a lot of crossing to the red territory, creating red impressions in the histogram in the MACD before. These were fake outs. How do you know that? Combine the information with the RSI. The RSI is climbing higher, meaning there is momentum and strength in the name. But when you see a double whammy for the stock here, well, the MACD is diverging lower, having a negative crossing. In combination with weakening in the RSI indicator, the risk versus reward suggests that you should take a shot and short this name, or take your profits if you own the name. Moving on, here's the last chart of the day and another name that I shorted on Friday via put options. Chamath dumped his shares. The Robinhoodists are eating a bag of shit. And you see the successful crossing in the MACD, creating red impressions in the histogram. It's been confirmed. It's been over-confirmed now. We see the RSI momentum curling downward. This stock is about to get hammered. Unfortunately, a lot of retail traders continue to buy the stock, buying call options. The company doesn't even have revenues to begin with. So I see more pain for space, and I did buy put options. And now let's move on to conclude this video. We passed the stimulus. Remember, here is the 4 layers of protection for the market. Vaccine optimism, we're done with that. Unless there is a black swan event, the mutation in Britain, if that evolves into a bigger situation where the vaccine is not effective, that could hammer the market significantly. We have the stimulus optimism that kept the market propped up week after week. We got the stimulus now. It is a lot lower than we expected. However, you saw the statement from Chuck E. Schumer saying that this is just the beginning and we are about to unleash another tsunami of cocaine to the market next year under the BlackRock administration. However, that depends on an outcome. Is number 3, the split government optimism, meaning that if the Republicans win in Georgia, remember what's going to happen. You think that the market's going to celebrate the split government optimism because if we have a split government, it is less likely to increase taxes. Here is the catch. F. Kelly Loeffler and Perdue, I think his name, from Georgia, the 2 Republicans, win the seats, forget about another round of stimulus. That would be extremely disappointing to the market. Furthermore, how would the market react on Monday now that we have the stimulus? Is it going to celebrate the passing of the stimulus, or is it going to concentrate on the fact that the Fed's liquidity facilities are about to be closed? It was a measure included in the stimulus bill that the Federal Reserve has to close its lending facilities as intended. The market might not like that. It might look at the stimulus as a one-time injection of cocaine. However, the market likes a continuation of the supply of coke. When you close the lending facilities, yes, you get a one shot, a very big one from the stimulus, but then what? The market wants more, and more. And here is the last bit. Remember, I don't know the details of the stimulus yet. I have to read it. But if we have a second round of airlines bailouts, the airlines will be a strong buy because the balance sheets will look a lot better than they were pre-pandemic because they got billions and billions and billions of dollars of free cash. Combine that with the vaccine and the airlines are ready to take off, baby. And remember, this is Christmas week, so Merry Christmas, Happy Holidays in advance. Remember, it is going to be a short week, half a day of trading, Christmas Eve, and we are closed Christmas Day. It's going to be low volume. This is the expectations, of course, low volume. Least path of resistance is upward. However, I'm waiting to see how the market reacts to the stimulus passing and the closure of the Fed's lending facilities. So it'll be very exciting. Even though most traders already left town, last Friday was the last day of trading, they might be dragged back to the market due to a surprise reaction due to the stimulus and the closure of the Fed's lending facilities. That's all I got for you. I'll talk to you again on Monday. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.